Hi, I'm Patu from Freefin Cal. In today's video, let's talk about why arbitrage funds tend to become more volatile when the market uncertainty increases or during a crash like this. And does it mean it will give you more returns, as some people believe? But then the bigger story is that today we witness something really special. It's not good special, it's bad special. We saw the biggest intraday fall and in the history of the Sensex, and if I'm not wrong, in the history of the Nifty as well. The previous fall was on 28th April 1992, and that was a fall of 12.77%. The Nifty fell, the Sensex fell 13.15% today to make this the new record. It's not a good record, but there it is. And then I have shown that a 10-year SIP in the Nifty has given a return of 2.3% before tax and before expenses. A 14-year return SIP return in the Nifty has given 5% before tax and before expenses. I'm not going to make a video on this today. I'll probably do it tomorrow with some, maybe posted in the morning. I don't want to make videos immediately after publication, because I published this only at about 4 o'clock today. I don't want to do that because I need some time for this to go through my usual distribution channels. After that, I want to make the video, so that's why I'm not going to talk about this SIP business. But you can go to the link in the description and get to this post. I'll also leave it in the first comment. And before we go to the arbitrage funds, let's get through this usual exercise. This is the graph that I've been updating every day. The different big crashes that the Sensex has seen: the Harshad Mehta scam in black, the 2008 crisis in blue, the dot-com crisis in green, and the current February-March to 2020 crisis in red and gray. And you can see that with today's fall, the Sensex has inched closer to a fall of 40%. It's inched close to 0.6. It's now fallen 37, a little bit more than 37%, if I'm not wrong. And that is the sharpest, fastest, quickest fall to 37% in the history of the Sensex. So we have seen something rather special, but I don't know how we're going to come out of it, is one way or the other. I don't know. Let's find out. Alright, so that's what I wanted to say. Now, two arbitrage funds. This is the NAV of ICICI Equity Arbitrage. You can see here December, this is January, 27th January, then it gets to February, then it got a little more volatile, and then towards the end of February and in March, you can see the up and down movements have become significantly higher. You can see this up and down movement much better in this graph. I hope you can see it, otherwise I'll just make it into a new tab. This is the 30-day rolling standard deviation of the ICICI Equity Arbitrage Fund. You can see the sudden shoot up in the standard deviation. Of course, it's not something new. This has happened before. It goes through different periods. You can see here this period. I think one of this must be close to the elections or the crashes in after that and so on, or probably during periods of demonetization, something like that. You can correlate it to these big movements. You can correlate to something. It's not new, but it's going to happen every time there is a volatility in the market. The reason for that is because of the very nature of the arbitrage opportunity. An arbitrage opportunity is a difference in price between the cash market, where you buy and sell at market price, and the derivatives market or the futures market, where you have a contract, where you agree to buy or sell of a particular quantity of shares or bonds or any other commodity at a particular. You will deliver this or get this quantity at a set date and at a predetermined price. And in normal circumstances, the price of the cash market and the derivative market will fluctuate, and then they will slowly converge, and so it will be like that. There'll be a difference. That's the arbitrage opportunity. And then as the contract expires, the prices will converge and they will more or less become the same on the expiry date of the contract. this is how ideally it will work. But then what happens is that in this kind of uncertain times, when at least the foreign portfolio investors, the foreign institutional investors may not be willing to participate in the arbitrage opportunities because they don't want to take the risk because of hedging, higher hedging costs, whatever, because of the forex, unfavorable forex that's happening now, the rupee is weak, and multiple reasons. So what happens is this gap becomes higher because of lower participation in the arbitrage segment. So what is usually this much becomes higher because of lower participation, and higher the gap, the potential for higher returns is there. But higher the gap, what will happen is there will be a lot of fluctuations and it may not converge correctly. The probability of good convergence may also get affected because of lower participation. The volatility will be significant, and because of that, you may not, the arbitrage opportunity may not ideally give you the return that's expected from it, and therefore the NAV of the arbitrage fund will move up and down. This can happen for as long as the uncertainty lasts. Maybe the monthly return of that particular month or maybe of next few months may be higher. It potentially, the higher volatility could result in higher returns. I'm not saying guarantee. The only thing guarantee is higher volatility. But then over a longer period of time, once the market uncertainty goes away, if it goes away, when it goes away, then the volatility will come down, and the extra returns, if any, will also come down, and then over a long period of time it should not make any difference. So this is nothing to be worried about. If you're holding arbitrage funds, you can continue to hold them. Don't bother too much about it. Just keep holding it for the long term. Don't use arbitrage funds for short term. It can bite you even on a normal day, even on a, when there is not much of uncertainty in the market, there's no big crisis like this going on. There is still a problem in arbitrage funds for short term. Do not use it. Use it for long term only. Minimum 1 year, preferably more. But if you can continue to hold it for the long term. But if you don't have arbitrage funds, and if somebody misguides you saying, look, volatility is higher, therefore you will get higher returns, that is a missell. Don't buy it. Don't buy into it. It will not last long. Even if that is actually true, it need not be the case. So that's what I wanted to say in this post. It's an exhausting day for me, tracking all the markets, getting all these SIP returns ready. I have to post my own portfolio, what I'm doing with and so on. I've given you some indication before. I think there's some kind of problem in my XIRR code. It's not changing much. People in Asana Ideas are telling me I'm completely wrong in my XIRR numbers. So I'll have to go back and look at it. But I'll at least try and post my portfolio growth, how it has shown and so on in the next couple of days. So that's what I wanted to talk about in this video. We'll talk about what to do with, should I rebalance now, should I wait and so on. Maybe I'll first write an article on it and maybe make another video on it in the coming days as well. If you have any more questions on this or any other aspect, please let me know. I'll try and answer. I've not been answering many of the questions, but then I'll try and find the time to do it. Thank you. Bye-bye.